Nimesh, investing can feel overwhelming for first timers, especially for someone who's just starting out or even someone who is starting late in life. What would you say to someone starting out in their investment journey?
So typically bull markets attract a lot of people in, right? Nobody opens a new demat account, or very few open a new demat account in a bear market. Everybody gets excited about equity markets when everybody is excited about equity markets. So that's one thing that people should be a little cautious of, that they get sucked in. They see that 2 years, 3 years market has gone up, it has given fantastic returns. Why am I not investing? I think that's the wrong reason to come into the market. Some people who think that in bull markets, it feels that making money is easy. So essentially they think market is providing a free lunch. Let's go for that. And then they become lunch for somebody else during the market fall. So I think whenever a new investor, a young investor comes into the market, it has to be for long-term goals.
Welcome to Wealth Creation Simplified, a special Paisa series powered by Bajaj Finserv Mutual Fund, where we break down the essentials of smart investing, milestone financial planning, and building long-term wealth. Whether you're just getting started or looking to level up your investment game, this series is designed to make mutual funds simple, actionable, and relevant for young investors like you. With that, let's jump into today's episode. Our guest today is Nimesh Chandan, Chief Investment Officer at Bajaj Finserv AMC. Nimesh brings over 25 years of experience in the markets and mutual funds. But for him, investing isn't just about numbers, it's about understanding human behavior. A keen follower of behavioral finance, he has spent years decoding why investors make emotional mistakes and how to avoid them. From managing portfolios to developing models on sustainable and quant investing, he has helped both retail and institutional investors make smarter financial decisions. If you've ever made an impulsive trade or panicked during a market dip, Nimesh is here to guide you on how to invest with discipline and confidence. Nimesh, welcome to the show.
Pleasure being here.
Fantastic. So, for the unversed, can you talk about your journey into the world of mutual funds and specifically what really sparked your interest or curiosity in behavioral finance?
So I started my journey in Indian capital markets as an analyst. And I started as a technology sector analyst in the year 2000. I mean, talk about bad timing.
What a time, I know. Got the
Missed
peak,
the entire boom. And when I started covering the sector, stocks were falling and I saw some of them fall by 80-90% in the next 2-3 years.
Yeah.
So bear market teaches you, I think, more lessons than bull market.
Always.
I think bull markets teach you the wrong stuff. Bear markets actually teach you investing lessons.
Yeah.
I took up also pharmaceuticals as research. So I was a technology and pharmaceutical analyst, which was a unique in the industry because two major sectors with one sell-side analyst is a bit too much.
Yeah.
But then 2003 onwards, I started reading about behavioral finance. So those days we used to work about half day on Saturdays. And when I used to travel back by train, I used to pick up some magazine to read, some Bloomberg magazine or Outlook magazine or so. And in one of these issues of Bloomberg, they were talking about behavioral finance and how some of the US funds were using psychology in investing decisions to improve their decision making. So that kind of made me curious, and that was the first time I came across this term.
Yeah.
And I started researching about them. I went through a lot of academic papers. Many of them were quite boring. But I found that this was the common thread that actually linked all the successful investors, that how they were able to manage their biases or understand crowd emotions when it comes to investing. But by 2004-05, I realized that while I can study a lot as an analyst about behavioral finance, taking investment decisions, putting actual money to work is different from just recommending. So you can write buy, sell reports, but it doesn't give you the feel of what goes on in the mind of an investor when actually money is at play.
Yeah.
So I decided to come to buy side, the mutual fund side in 2005. So I tell people that I actually came from sell side to mutual funds, chasing Saraswati, not Lakshmi. Thankfully, Lakshmi followed.
Yeah.
And for 20 years, I've been trying to be a learner in behavioral finance. I did a short course with Hirsch Sheffrin in 2011
Okay.
in Amsterdam Institute of Finance on behavioral finance.
Wow.
It was a good experience. But at that time, behavioral finance was accused that it shows the problem, but it doesn't give the solution.
Okay.
So then for the next 10 years, I've been developing tools and ideas which actually help rebias or debias some of your biases and how to identify what the crowd is thinking.
Very interesting.
So made the processes on that for Bajaj Finance,
Kahneman-
Bajaj Finserv AMC.
Kahneman and Tversky are like in your top 3 list of books, or is there anybody, or you must have a long book of behavioral finance?
Absolutely. The 3 people I follow is obviously Daniel Kahneman because he triggered this. He was the first psychologist who won a Nobel Prize in economics.
Yeah.
Then Robert Schiller in 2013 and Richard Thaler in 2018. All 3 won Nobel
Wow.
Prizes.
Yeah.
I've been following their studies for a long time.
Schiller is what? Irrational exuberance? No, he was the Cape theory or something?
Yeah, both. So
And-
you are absolutely right.
And Thaler, of course, is nudge. So how can you... I mean, you've got all 3 covered out there. But I hope that you start writing also out here for India. Nimesh, investing can feel overwhelming for first-timers, especially for someone who's just starting out or even someone who is starting late in life. What would you say to someone starting out in their investment journey?
So typically bull markets attract a lot of people in, right? Nobody opens a new demat account or very few open a new demat account in a bear market. Everybody gets excited about equity markets when everybody is excited about equity markets. So that's one thing that people should be a little cautious of, that they get sucked in because they see that 2 years, 3 years market has gone up, it has given fantastic returns. Why am I not investing? I think that's the wrong reason to come into the market. Some people who think that in bull markets, it feels that making money is easy. So essentially, they think market is providing a free lunch. Let's go for that. And then they become lunch for somebody else during the market fall.
Yeah.
So I think whenever a new investor, a young investor comes into the market, it has to be for long-term goals.
Okay.
To meet their long-term financial goals, understand how over a longer term the market works.
Sure.
I think that's very important to come with a long-term perspective. Research well before you start your investing and when you are investing. And I would also say evolve a investment philosophy and process. Nobody is 100% right in investing. But if you analyze your successes, your failures, your losses, and evolve a process that this is what works, I think that for a young investor can lead to good long-term wealth creation.
Very interesting. You've seen markets over decades. Are there any lessons from your early career, that resonate strongly in today's investing environment?
So a lot of them actually. We all start with thinking again that it's easy to make money in the markets, get sucked into a rally, follow the crowd all the time. I think one of the most important lessons is that crowd is right on trends but wrong at ends. If you analyze centuries of market movement in any asset class, right from gold to tulips to stocks, you will find patterns that though events were distinct, patterns are similar. That people get excited about an asset class or a theme and they chase that theme to high valuations. Expectations are very high. People start believing any narrative that is given to them, end up paying extremely high price. Then over a period of time, realize that the reality is very different from the narrative that was sold or the story that was sold. And then there is a panic to get out. That, okay, we made a mistake. You get out. And then they overreact on the downside. So I think understanding this aspect of market, that within these business cycles and economic cycles, there's a very strong sentiment cycle, which exaggerates these highs and lows. Understanding that is extremely important in investing. It was true earlier, it is true now.
So behavioral finance, right? I think Thinking Fast and Slow is what the original paper was written somewhere in the 70s, on which the book is
Prospect
based.
theory.
Prospect theory, right?
Yeah.
It came in an investment journal, and of course at that point of time things were very different. So it's had a long record, but it's gaining traction now, I think, in the last 10 odd years as a discipline. Why do you think it's important in today's market?
So I would say it's been important all the time. So it's more important today, but it's important all the time. If you see the book that most of the fund managers, analysts, investors read, is this book by Benjamin Graham, who's the guru of Warren Buffett. He's written the book Intelligent Investor. The first edition was in the 1950s, I believe, or late 1940s. In that book, you won't find any shortcut valuation technique or like, okay, this is the way you make money in the market. But it's a very important book for everyone, despite not having any formulas. And that's because it talks about how temperament is more important than knowledge when it comes to investing. In the very introduction of the book, on page 8, if you want to check, Benjamin Graham writes that in this book, we'll be talking a lot about the psychology of the investor, because most of the time, the chief enemy of the investor is likely to be himself. And then he explains how a conservative investor, how a aggressive investor, how they should look at the markets and look for opportunities within them.
Very interesting. It's like saying that no matter how many Excel sheets you make about DCF and PE and all that, ultimately the buy-sell decision is going to be led by temperament more than anything else.
And I would say add to this that today it is more important because, see, you have typically 3 edges that you can have to do better than the crowd. Yeah. First is an information edge. Suppose you have superior information. Second is a quantitative edge, where you process the information better than the others. And third is the behavioral edge, where you react to the data and the output better than the others. If you see, the information edge is becoming thinner. From, okay, if I have information, I'll do well, to if I don't have information, then I'm in trouble. So information edge is becoming slimmer because of AI and the advances on the quant side. Yep. You will also see quant models being available, and this quantitative edge, some point of time, people will copy it and do the same. Correct. So that's why behavioral edge now becomes even more important than what it was earlier.
So young investors, our largest demographic in India, at least the youth, of them, I hope more become investors. So they struggle with emotional reactions to market volatility, right? Because markets are going up, they're happy, markets are going down, they're sad. They associate this with some emotional reaction or the other. What are the most common biases you've observed, and how do they affect the investment outcomes?
So whether it is young, new investors who come in, or experienced investors who have not really evolved or thought about investing in a disciplined way, they tend to react by more emotions. We are, as humans, it's natural to be emotional. And whenever we put our hard-earned money on something, naturally a lot of biases and emotions play a role. So this is natural for us. Some of the common biases that I have seen people fall prey to over the years, whether it is new investors, old investors, retail or institutional. First is confirmation bias, where once you've decided something, you start looking for only those data points or facts that confirm that you've taken the right decision. In fact, there's the opposite of it is called cognitive dissonance, where you try to rationalize. If somebody comes and tells you negative about, okay, there's a risk in your investment, we try to rationalize, no, I have studied this will not happen. Confirmation bias means you stop looking at risk, you stop looking at what can go wrong, and then you're not prepared for things to go wrong. We are all predicting the future.
Yes.
And it doesn't unfold exactly as the way we want. So unfortunately, because of confirmation bias, a person is not prepared. What if something goes wrong? The second common bias is overconfidence. If you have a patch of good trades, good investments, people rarely analyze their winners. They don't try to classify whether this was luck or skill, whether it was really what I was looking for, or it just happened, or it's a market that raised all the stocks. Overconfidence can lead to people taking leverage, people trying to make quick money, trade more, and that doesn't end well. And the third important bias is loss aversion. This stops people from buying when actually the market is falling and is at an attractive level. because there is this myopic loss aversion that while I see the stock price can go to 200, if I buy it at 100, what if it goes to 95 or 90, right? And people are quick to take profits when something goes up, but they keep investing in their losses, even if the decision that they took has become nullified by the changes in the business or management.
Still believing in hope or something.
So these are some of the common biases observed in most investors.
Very important ones. For younger investors, trends like crypto or meme stocks can create a sense of urgency or FOMO. How can they avoid getting swept up in hype cycles?
So actually there is a neuroeconomic study that shows that we are more prone to think short term. We are prone to trade. We are prone to think of quick gains. So there is a pleasure chemical in our head called dopamine, and that is generated when suppose you find something, your favorite food, or when you're hungry, you find some delicious meal available, or chocolates, or for some people maybe alcohol or something. Right? It generates a pleasure chemical in our mind.
Correct.
And that is a pleasure chemical that also drives us to trade because we look for quick gains. Even if we initially came with a long-term plan, we love quick gains. So that shows that human beings are more prone to trading and thinking short-term. So actually it takes effort to move to long-term thinking. It takes effort to control some of our emotions. The one thing that investors can do, and especially young investors, they should keep anchoring on long-term, their goals, their long-term plans, what investments they are looking at, they should look at long-term. Now, suddenly, if you think of long-term, the entire design of the market looks very different to you. Suddenly, dips become opportunities, right? Rather than chasing a stock up or a market up, you look for dips that, okay, now I can do better compounding from here. You choose assets differently. Companies that you would want to hold for longer term.
Correct.
Rather than those which somebody told you, as a tip, ye le lo, ye bhag jayega type. So, the way you select your themes, the way you think about risk completely changes. And studies have shown that short term, most traders lose money. And at best, a small percentage gets average returns. So this is a crowded short-term side of the market where people are trading every day, getting average returns or maybe poorer returns. Long-term highway is like empty. You take that course, you create long-term wealth, you're not in the crowd, and you have a more peaceful wealth creation journey.
Which in fact brings me to the point, I think, that seems to be underlying whatever you said, which is patience. Okay, now patience is something that's not available in the short term, the way that we think. What role does patience play in investing, especially for younger investors, for Gen Z, who might expect quicker returns?
So if somebody is looking at investing and is impatient, wants quick money or something, they end up actually taking more risks. In the short term, market is a voting machine.
Correct.
And in the long term, it's a weighing machine. In the short term, it's about the flow of liquidity, who's buying, who's selling, who's owning the stock. Those things determine. And it's very difficult to put an analysis on that and time it. In the long term, it's a little more clearer view that what businesses do well, what are the typical characteristics of winning businesses, what are the right valuations to be paid for them. A short-term investor doesn't care he or she is paying 100 times profits because the person is just looking to go to 102 times. It's a greater fool theory. Somebody will buy from me at a higher price. That's why I'm buying today. So they may end up making mistakes, taking more risks in that. I would say develop an investment philosophy, a good process to select your investments, and have a checklist. Something that we use for our own investment selections. We call it the investment checklist. Have criteria of what kind of investments you will make, what are the long-term targets, or what do you expect that to happen from them, and then go on that journey.
Sure.
An investment philosophy, process, things like tools like investment checklist help you stand for something. And if you don't stand for anything, you will fall for everything.
Correct.
So I think it is not easy to develop patience on its own. You better have a process that helps you stick to this journey longer.
Just to make this more realistic, if you can share a real world example, where sticking to disciplined approach, SIPs for examples, helped an investor overcome behavioral pitfalls.
There are many examples, and if you look at asset allocation, if you look at SIPs, now let's take SIPs as an example first. SIPs, most of them are automated, right? You give a standing instruction to your bank to put money in a particular fund, a certain amount of money every month. Now, instead of that, suppose somebody from the bank needs to call you every month on a particular date to confirm, sir, this is your SIP of 5,000 rupees. This is the fund you are investing in. Should I go ahead? Now, if this is how SIPs were invested, most of the time, people would keep changing the amount or keep changing the fund, and based on the market mood, they will decide whether to invest or no. Now, this becomes dangerous. So SIPs work because there is a pre-commitment. There is a certain discipline that you work with. Same works with asset allocation. People who are planning some long-term goals, say children's marriage, retirement, or buying a house or something, whatever the financial goal is. If they understand, or with their planner or somebody, understand how asset classes move and do the right asset attribution or asset allocation on them with a pre-commitment that once another asset becomes cheaper, I'll switch from the expensive to the cheaper one. That creates better wealth. Top-up SIPs is another example that when the markets are down and you want to increase your allocation, do a top-up SIP. Another example, one of the Richard Thaler ideas was save more tomorrow. You pre-commit that if I get an increment of 10%, say next year, or I got this tax benefit from April where I'll save 60,000 rupees.
Sure.
Out of that, a certain percentage, I'll start a new SIP or a investment. It's easy to promise a little bit in the future because you don't feel the pinch that I'm compromising on my right now, my spending, my consumption for the future. So this is a good way to do a pre-commitment on an asset allocation, on an SIP, on saving that helps you keep discipline. Once you are disciplined, there is a lot of wealth to be created.
You remind me of 20 years ago, maybe our listeners also, our audience would not have been around at that point of time of how an SIP used to operate then. SIPs aren't new. They've been around for quite some time. At least I remember attempting to try one, and I think I had to sign PDCs. Post-rate checks, like pura bunch you have to then deposit with the bank would do it. Technology has really helped, right?
Absolutely.
I mean, without that, so I don't think this would have even been possible, especially from the behavioral side. I remember that if I have to sit one day and keep on signing 12 post-rate checks, I don't know if that would have been possible for me. So technology has helped, right?
Absolutely right. You're bang on there.
Okay, Nimesh, you spoke a lot about technology also, so with technology evolving rapidly, do you see AI or data analytics helping investors better manage their emotions and biases? For example, how do you see AI with generative AI tools like ChatGPT or Gemini in helping investors?
So, let's say people react to an output of a system differently based on their own emotions, biases, and different people can be acting quite differently in the same data. So you say this morning there was this news that Nifty is down like 5th month in a row, which I think last happened in early 90s. Okay, for 30 years it has never happened. Now the same falling chart, somebody would get scared. Oh, it's like, this has never happened before. This is going to fall keep falling.
Yeah.
And I've heard Nifty can go to much lower levels. Let me sell. And the same chart, somebody will look at it as an investment opportunity, saying, oh, this was a good opportunity for me to pick up these investments, which I was looking for anyway. I had kept some money around for that, and I'll use that. So people react to output or data that they get differently. What AI and quant models can do is, one, they can help you get information, right information soon. So quicker access and easier access to information. So you don't miss out on the information that will help you doing your research.
Sure.
Second, you can use them to run certain back tests. You can use them to run certain theories. Does this work in the market? Has somebody used this idea before? And so on. So it gives you the right quant output. So information edge, quantitative edge gets better with them.
Sure.
Behavioral edge, I still believe that it's how you use these tools to get better decision making is important. They may not be a ready kind of answer to the biases that one has.
Nimesh, I'm just trying to understand people who have just started their SIPs. Now the numbers at the industry level look really good. The internals have some issues here and there. But I guess you think that this is just the early wave of people getting used to an SIP, and behaviorally, how should they be now thinking of continuing this behavior over the longer term, right? Because stopping an SIP or being in the wrong place at the wrong time, getting jittery when you see the market fall. What would you tell these guys to make this into a discipline to continue it into the future? What does the future hold, for example?
So we've seen in the markets, it's a story of cycles. The crowd moves like a pendulum between greed and fear. And if you keep swinging with that pendulum, you don't make great returns. In fact, you will have substandard returns. You will only end up paying taxes and trading costs on that. So it is important that you create your own plan and stick with it in terms of discipline. I'm reminded of the marathon runner Eliud Kipchoge. So he's the only person who's completed a full marathon within 2 hours. He completed in 1 hour, 59 minutes and 40 seconds.
Wow.
And this was a special run that he had. He said, I will want to choose the place I'm running this because I'm trying to break the world record or do this extreme feat. So he chose Vienna, where he found a place where there is a flat road and a long road, which is good for running. And it was, the climatic conditions were better or similar to Kenya, where he was actually practicing. So he chose that road, that this is what suits me in terms of running. Second, he had a few people running with him in front of him, which is forming a kind of a triangle in front of him. And these are also gold medalists or silver medalists in running. They used to change every 15 minutes. So they didn't complete the whole thing. They were running in 15 minutes, but they used to create a certain, reduce the air resistance for him, which helped him run at a certain speed in a good way. So now Eliud Kipchoge shows you that if you want to do something extraordinary or get extraordinary returns maybe in investments, first, don't copy others, choose what suits you better. So your financial goals, your temperament, your risk appetite, select accordingly on that. Second, network with the right people.
Very interesting.
If you are networking with people who are day traders and you are a long-term investor, what they talk about and those conversations will start affecting your decision making.
They will.
Also, in the media, if you're continuously looking at short-term news, that chatter affects you. Even if it doesn't change your investment decision, it affects you. It forces you to act. So investors need to choose what is suitable to them as a strategy. Choose the right people to network with so that it acts as a noise resistance for them. And then they are able to do a disciplined investment over a period of time. Fear is one of the most strongest emotions that one has, and it is very difficult to control. The only way you can reduce its impact is step back a little during volatile times, talk to the right people, connect with the right people, and refocus on your long-term goals. Then you have a better chance of not selling in fear and panic, or stopping your SIPs during this time, and or chasing a market. Okay, let me just grab a little bit more in this bull market. So those kinds of emotions can be controlled.
Nimesh, what's happened is that social media has increased what was already there inside our brain, which is herd behavior. People feel comfortable in crowds. I think even historically, the way our DNA developed, whether it was tribes or whatever, we just like to fit in. Being one of staying outside is always requires some effort, requires some bravery, so to say.
Yeah.
It applies to markets also. We've seen how there are flavors of the day or the month or, a sector runs, whatever it is. So how does that impact behavior,
Herding is again very natural to us. So imagine you're going to a new city, you're traveling to a foreign location, and you've done some sightseeing with your family. In the evening, you have to decide where to have dinner. And you've chosen the cuisine. On the same road, you find two restaurants with the same cuisine. Prices, say, are almost equal to each other.
Yeah.
One looks very busy and crowded. The other is almost empty. Which one would you choose?
The crowded one.
The crowded one, obviously. Because we feel comfortable that so many people have chosen this means something is good here.
Yeah.
And it works in many areas for choosing a film or what to watch on Netflix or Prime.
Whatever it is,
Many a times it helps us select or make our decisions easier to be with the crowd.
Yeah.
But in the markets, unfortunately, it doesn't work that way. In markets, the crowd often is driven by a narrative. So there is no diversity of views that come in a crowd. If you see animals when they herd, many of them are looking at different directions. So if there is a danger coming from any of the sides, that animal will warn the other in the herd and they will start running. Unfortunately, because some of the narratives and stories in the markets are so seductive, that imagine the entire crowd is looking in one direction. Yeah. So that cuts the diversity in the market. And if there's no diversity of views, prices move away from their fair value, either up or down, depending on the sentiment in the market. So this is where if you go with the crowd all the time, then you are also driven by the same narrative. There is no independent thinking involved as to whether this is right or wrong. So we feel comfortable in the crowd, but in the markets, it becomes a bit of a worry. What one should do is try to think differently or think contrarian, or as Charlie Munger says, try to invert and see whether if something is looking very attractive in terms of a story, does it fit into the numbers? And also what is called backcasting and forecasting, which a lot of gamblers do. That can you reverse engineer and see for this stock or for the index to go up to this price, what all is required and does it look possible now? Rather than just giving a target, okay, this will double.
Very interesting. I know that we've spoken a lot about behavioral finance, and in the starting of the show also you spoke about how behavioral edge is important. We've spoken about how temperament is important. How does one realize where he is? Right? If there is an investor who's just starting his journey, how do I appreciate risk in a better way when it's personal to me?
So investment is simple, but it's not easy. We need to, if you're doing something of your own as a study on investing and trying to be a good investor on your own, learnings from 4 different fields become important. And I think much time is to be put in reading, listening, learning about these areas. So 4 areas are history, businesses, psychology, and market concepts. So if you have a hold on these 4, then you are on a path to becoming a good investor. It's not difficult. So maybe when I'm saying this, it sounds a Herculean task. Okay, if I have to do all this for being a good investor. I think these days, good information, good analysis is available for people. Uh, successful investors regularly share what they are doing. But if you have a hold on history, you know how markets behave.
Yeah.
If you have a good hold on businesses, you know what you are investing in.
Yeah.
The worst mistake you make is you don't know what you are investing in. You are just playing on the stock prices.
Yeah.
Psychology. One, to know that sometimes your own biases can impact your decision making.
Yeah.
And second, that the crowd can overreact also based on what the news is going on in the market. So, psychology is a mirror as well as a lens to look at the markets. And fourth is about market concepts. You need to have some grip on how a valuation is done in the market, how asset allocation is done, what are the ways in which, like say, SIPs or some of the tools that one can use to improve the discipline. We've created some in-house tools to our own decision making. So we use things like an investment journal to write down so that we know at the end of the year what went right, what went wrong.
Correct.
Whether it was luck or skill. Analyze successes as well as failures. Many people analyze their failures but don't analyze their successes. That if there's something I can learn and just put it into my process, so I just keep repeating my successes, right? We use things like a bull-bear case scenario, what is called pre-mortem, to when we look at valuations, what can go right, what can go wrong. And to your question about risk, when you create a bull and a bear case scenario of what can happen in the future about this company, you know what's the upside, you know what's the risk. That helps you take better decisions. And I would also like to clarify that if you know a risk in a particular investment, doesn't mean that you don't have to do that investment. It actually strengthens your investment case.
Oh, okay.
That now you know that I need to monitor these parameters, and if they don't conform or with my thesis or change dramatically, then I need to change my decision. It is okay to change your mind.
Sure.
It's not okay to change your mind but not do anything about it.
Okay, so if you had to sum up one principle for young investors to stay grounded during market fluctuations, okay? One principle for young investors to stay grounded during market fluctuations, what would that principle be?
Think long term. Investment is more about temperament than knowledge. So these cycles will test you. Just see to it that you have the right tools to keep yourself in the right temperament of investing. There is a lot of wealth to be created in the Indian markets, and with the right temperament, with the right process, they can achieve it.
Fantastic. And that's a wrap on today's episode of Wealth Creation Simplified. We've explored how behavioral finance shapes our investing decisions, the biggest emotional pitfalls to avoid, and how staying disciplined can make all the difference in long-term wealth creation. A big thank you to Nimesh Chandan for sharing his insights on investing psychology, market biases, and how young investors can build a resilient financial mindset. If you've ever felt uncertain about investing or let your emotions dictate your decisions, this is your sign to step back, stay the course, and trust the process. If you found this episode helpful, make sure to like, share, and subscribe to the Paisa Vaisa YouTube channel and follow us on Instagram so you don't miss out on the next few episodes of this special series. Thank you, Nimesh.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.